Welcome to StockOdds Odds and End podcast. I'm Dave Singh here with Rob Friesen, getting ready for the week ahead. Good evening, Rob. How's everything?
Not too bad. Had a busy weekend, but I'm still behind on things, but we'll hopefully get caught up here. It's going to be a shortened week, right? We got a holiday on Friday, Good Friday. So it's going to be interesting, and especially as we've got the start of the new month and what that normally entails, and coming on the back of the rally that we had last week, which was pretty impressive towards the end. Did you notice all the window dressing that we had?
Yeah, I mean, even like an example like Tesla, right? It's been down most of the month, and then suddenly it rallied hard right into the close there on Friday there. So it's like everyone wanted to show off that they own the best things that performed over the quarter.
Yeah, I did some spot checking, and it looks like, the things that were definitely performing well for the month already, and for the quarter combined, looks like the things that they went after first. And then, of course, some of these other things got caught into it too. Me too. I don't want to be left behind. But it definitely was window dressing in the sense that the optics, people like to show that they do hold the symbols that have been doing well. And that doesn't necessarily mean that's going to be working out the best for investors or shareholders ultimately, because you could have a pullback in the next quarter. And so, having paid up potentially for some of those symbols this week, especially if you did it on Friday, it may not hold water through earnings season, or how about sell in May and go away if that holds true, right? So I think it's not a good, framework to do things just because you want to show the optics. They had plenty of time to buy a lot of stuff on the cheap, and that's going to usually pay investors a lot better. But anyway, it is what it is. We ended up, let's see, so far for this quarter, NASDAQ's up 16.8%. The S&P's up 7%. Even the mid cap up 3.4%, and the Russell up 2.3% year to date. And then the Dow Jones up only 0.4%, which it was, down most of the year so far, right? And it just managed to finally poke its head above break even. So again, it's in keeping with what happened last year. The things that got beat down the most seem to come back the most, right?
It's like,
and those that were not down as much.
Of the Dow theory.
Exactly. It still works after all these years. And it's not just about the Dow. I mean, nowadays it's different markets entirely. And also, there's the survivor bias thing that affects these markets too, because they keep having stocks added or subtracted, mergers happen, and, problems happen. They get removed from one index and put into another one, so there's lots of changes all the time. So that affects partly the year-over-year performances. But anyway, Friday was interesting because some of the economic data really suggested that inflation was, being dealt with, that the concerns weren't as exaggerated as they have been. And maybe that means that the Fed would go actually a bit easier. And so that's why the market's really hopeful for that. We had, let's see, I think the bigger one that brought it into focus was the PCE data and the Michigan consumer sentiment. So again, a lot of focus on Friday about the consumers. I noticed the, Russell list that we had did really well, was up about 2.15% for the symbols. There was only 2 symbols that were red out of 20 on our our Russell list, and that hasn't been the case for a little while. Russell's been a little bit struggling just because the small caps had fallen out of favor so much. But when you see people kind of get some confidence back, that's where they like to run. They like to run back into some small caps because of the growth potential, and also the betas are pretty substantial. Volatility is good, so if you can catch it on an upswing, you can do really well with the Russell stock. So we only had like I said, 2 out of 20 that were red. All the rest were pretty green, and they were up like 2.15% collectively versus the IWM from open to close was only up 1.13. So there was some alpha there. All right. So what's on your radar here for the first week of April in terms of seasonality? What do you see?
Yeah, so we have 2 seasonalities this week. We have the first trading day of the month and also the first Friday of the month. For the month of April, the S&P is expected to do 2.4% and the NASDAQ at 2.6%. So it's still a good month overall. But first trading day is actually a down day typically, minus 0.48%. And then the first Friday of the month, minus 0.13% for the S&P. So a little soft the first day, and then on the Friday as well. Then let's look at some of the sectors that are expected to do better or worse. So first trading day of the month, soft, longer things like gold, oil, and short jets like the airlines. Retail, XRT, home builders, XHB, ARC funds, so a lot of the risk on high beta stuff, and also some financials, KBE and KRE. And then when it comes to the first Friday of the month, again, longer gold, oil, biotech, XBI, IBB, real estate, and then short again, jets, which is airlines, financials, KBE, KRE, and some of the chips, SMH and SOX, right? So those are the ETFs that may or may not do better than others. And then we have, in terms of economic reports, we have Monday, we have S&P 500 U.S. manufacturing reports, construction spending. On Tuesday, we have factory orders, job openings. Wednesday is the ADP employment report, PMI. And Thursday, jobless claims. And then Friday, first Friday of the month, we always get that U.S. employment report. So the backdrop in terms of reports will be how the economy in terms of manufacturing is still going, job openings, employment data, unemployment report. So those are the major economic reports. And earnings, not too much going on. Tuesday, Acuity Brands, just a handful, ConAgra, Levi Strauss, WD-40. So it's just a couple earnings there. Mostly, it's going to be probably a focus around employment. Are we seeing any crack in the employment numbers? Because we've seen inflation coming down, but not the employment market. So that's going to be the focus of the week.
Okay. Well, yeah, the dollar, I think, really plays into the gold thing, and the dollar's up right now. So we'll have to monitor that. So I always look at the seasonality and say, is it plausible? Do we see this history repeating itself? What are the catalysts that could be complementary or opposing? So that's where I bring the dollar into the equation, as well as sort of what's going on in fear land. Like obviously Friday is not an example of fear. What we had fear more in the when the banks were really under pressure, and we saw some relief with some of the mergers and bailouts and things like that, right? Mm-hmm. So just kind of keep that in mind. I mean, there's not every sector always has the same kind of meaningful catalysts, but when you have negative correlation like you do with the dollar and metals, it's definitely something to watch. let's just run through our futures here. So as of the moment here, we have the Dow Jones trading pretty much flat. Since it opened with 6 p.m. Eastern time, it hasn't done a lot. It's been kind of sideways here. So really not seeing too much from the Dow Jones futures. And the S&P is down slightly. It did have a drop from Friday's close, well, after hours close. It did have a drop, and it's been, again, trading sideways down 10.5 points or 0.25%. The NASDAQ is down a little bit more. So technology had an amazing run on Friday, and of course, for the week, things were picking back up a little bit with NASDAQ, but earlier in the week, it was softer. NASDAQ's down 75 points or 0.56%, and it's not trading sideways. It's kind of actually drifting down at the moment. And the Russell is trading sideways. It's down 0.18% or 3.2 points. The VIX, which we've been monitoring carefully, is one of our leading indicators, had pulled back substantially this week, getting close to the 20 level again. Right now it's sitting at 2120, up 2.10%. And so it might be on the back of some of this oil news, which we're going to talk about momentarily here. First, I'll go to the bonds. Bonds are interesting because they're kind of back in that middle of that range that was the highs. Looking at the 2-year note, like we had this resistance level from December all the way through February. In March, it declined to new lows there for the year and even for last year. And so from that, then it shot up, started on March the 9th and just ripped up with the banking crisis and lifted all the way through that resistance level. And now it's pulled back to sit on top of it or kind of right in the middle of that consolidation. So that's the 2-year, and the 5-year, 10-year, and 30-year are just a little or a lot less aggressive version of that. The 2-year, obviously the most sensitive. So bonds at the moment, just looking at where the 30 is down 0.21%. So should be fairly stable now and not something as volatile as it has been during the banking crisis. Till the next one, right, Dave? Until the next one.
It was such a rapid move in March. I mean, we were the yield on the 2-year was over 5%, went down below 4. Yeah. Now it's at 4.11.
Yeah,
these are huge movements.
So the U.S. dollar pulled back for pretty much all of March. From the 7th of March, it pulled back all the way, and it's Friday bounced a little bit, and then this evening here it's up again a little bit. So it's up 0.49%. So looking at what that's doing to the metals, gold was down on Friday, but still an inside day relative to Thursday, and tonight it's down 0.92, almost 1%. So it'll probably want to head back towards the 1950 level from the 2000 level that it touched on Friday's high there, and then pulled back. Okay, copper, again, recession indicator or not, is stable sideways, not really doing much of anything. And now let's go to the big story of the day, is energy. Okay. Now, what's going on in energy? Well, first of all, contrary to, the U.S. requests of OPEC and other leading members to cut or hold things as is, or sorry, to supply more, supply more, or at least maintain. OPEC Plus has decided to cut production by about 1.5 million barrels, and that'll be starting in May. And so the countries involved, Saudi Arabia will reduce by 500,000 barrels per day. Russia will reduce by 500,000 barrels per day. UAE by 144,000 barrels per day. Kuwait by 128,000 barrels per day. Iraq by 211,000 barrels per day. Algeria by 48,000 and Oman by 40,000. So, you can see who's all in bed together, right? And anyway, so they want to stabilize the global fuel market, right? Now, add to that the news from Japan. So it breaks with U.S. allies, and it's buying Russian oil at prices above the cap. So it got an exemption. So it's going above the $60 a barrel cap because it's got energy needs. Well, so does everybody else.
Yeah.
So, I mean, this thing is just crazy. So let's take a look at our crude here. So we were up a little bit more earlier. We've pulled back. We were up about 6%. We're currently up 5.63%, which is a huge change. That puts it it was up at 81.5 on West Texas, and it's currently sitting at 80, just under 80, 79.93. So West Texas is now going to be also contributing to more oil pricing related to Brent crude, just because of the supply side on the Brent has diminished. So, but Brent's up 5.47. So they're pretty closely aligned. So there used to be more differences between the two contracts, but they're more closely aligned. So there you have a big pop, and it's pulled back somewhat. So what is this going to do? It's going to put some pressure on oil stocks to jump tomorrow. Now, there are some, pure plays that respond much more aggressively than some of the major integrated, where they're more diversified. So that's one thing to note. If you have in the past studied correlation, because we always have like hurricanes, or we've got all kinds of things that disrupt. Remember the ship that got stuck in the Suez Canal? I mean, we've always got something going on that disrupts oil. When the war started, and so if you've already studied which symbols tend to move the most relative to the futures, then you can play that game tomorrow. Now, there is a chance that things kind of open way too aggressively and overshoot, what they should be doing, and then you have from open to close potentially a pullback. So don't assume that it's gap and go. It could be gap and retrace. But that's only day one. And again, these cuts aren't going to start until May. So there is some time for this thing to stabilize. But I've been talking about oil being very discounted, in the middle of March, and, abnormally so. And I basically talked about the opportunity for, coming out of that $66 a barrel area that was looking for some upside. And so this brings us right to the top of the range, the high from March, the high from February, and into the consolidation area from January. So that's where we popped up today. So a big gap, obviously, a big driver, and it's going to impact a lot of things. I mean, it's a small sector relative to the S&P. Like, we'll look at the amount of financials in S&P, for example. I mean, so energy is a small sector, but it's psychological, it moves markets, things like that. So what this could mean is that if oil were to really gain traction, that would put more pressure on the Fed to go easy on the markets too, right? So that debate, you'll probably hear that tomorrow on some of the news channels as to what does this mean. But this is the big driver today is crude oil. So what basically for this week already, this past week, we had all 11 sectors gained. Energy was up 6.2% for the week. Consumer discretionary 5.6, real estate 5.2, and communication services 1.5, and healthcare 1.8. But all 11 sectors had a good week. Anything else on your radar here?
No, that's it.
All right. Well, fasten your seatbelts for an interesting week, and compressed at that, right? Only 4 days to make hay. So good success, everyone. Catch you here next week.